The institution responsible for processing roughly $11 trillion in transactions every single day has now confirmed it will begin placing traditional assets onto blockchain rails before this year ends, and XRP sits directly within that evolving framework. What's unfolding isn't just another crypto headline. It's a structural shift in how large-scale capital could circulate across the financial system. To understand the magnitude, you need context. The DTCC isn't a niche fintech startup. It acts as the clearing and settlement backbone for the vast majority of U.S. securities transactions. When it upgrades infrastructure, the ripple effects spread across the entire market. And this time, the upgrade involves tokenization, converting real-world assets into blockchain-based representations that can move with far greater efficiency. This isn't a 5-year roadmap concept. It's scheduled infrastructure development happening now. The link to XRP is no longer theoretical chatter. It's embedded in operational pathways created through strategic decisions Ripple executed over the past year, decisions that flew under the radar for most observers. If you hold XRP or track institutional blockchain adoption, the real value lies in understanding the mechanics, not speculation, not hype cycles, but the architecture being assembled piece by piece. In late 2025, the DTCC secured a critical regulatory green light from the SEC in the form of a no-action letter. That clearance effectively authorized the rollout of tokenization services. This wasn't exploratory discussion, it was approval to proceed. The implementation window targets the second half of 2026, meaning participating institutions will soon be able to tokenize deposited assets and distribute them into designated blockchain wallets on supported networks. This represents live infrastructure, not an experimental sandbox. Here's how it works. Institutional participants request tokenization of eligible assets. Once processed, the tokenized versions are delivered to the blockchain wallet of their choosing. The procedure sounds straightforward. The implications are enormous. Now consider scale. The DTCC safeguards close to $100 trillion in assets. The stated long-term objective is to tokenize that entire pool. Not immediately, of course. Systemic caution is required when you manage the plumbing of global finance. But the ambition is explicit. Full digital representation of the asset base over time. Tokenization here isn't about novelty. It's about collateral mobility and liquidity optimization. The DTCC is also preparing a collateral-focused application chain expected in 2027. The goal is to allow institutions to move collateral globally at network speed. Today, cross-border collateral transfers are slow and rationally complex. Blockchain infrastructure reduces that friction dramatically. Speed and finality of settlement become competitive advantages. That's precisely the arena Ripple technology has targeted for years. The DTCC has emphasized interoperability. Rather than locking into a single blockchain, it intends to collaborate with multiple Layer 1 and Layer 2 networks. Asset flexibility is the objective. Among leading Layer 1s for real-world asset issuance, the XRP ledger continues to expand measurably in this exact category. In Japan, SBI, a longtime Ripple collaborator, introduced blockchain-based bonds that distribute XRP rewards to investors. The issuance totaled approximately 10 billion yen, targeting retail participants through a fully on-chain framework. Investors receive XRP equivalent shortly after subscribing, with additional XRP rewards scheduled alongside interest dates in future years. Traditional fixed-income instruments are being combined with digital asset incentives within structured products. The bonds operate on a blockchain-managed registry, with administration handled by a major banking partner. This is not a test concept. It is a functioning financial product integrating XRP into payout mechanics. When a deployment proves effective in one advanced financial market, replication often follows elsewhere. At the same time, Dubai has outlined plans to tokenize $16 billion in real estate by 2033. Already, millions in property value have been tokenized on the XRP ledger, with official land registry integration and custody support. The pilot phase succeeded and advanced to expansion. Real estate is historically illiquid and administratively heavy. Blockchain representation enables fractionalization, transparency, and faster transfer. If one jurisdiction demonstrates scalable results, Others typically observe closely. Tokenization of property, commodities, and other tangible assets continues to grow on the XRP ledger. Asset totals on the network have surged dramatically over the past year, reflecting accelerating adoption. Taken together, these developments form a pattern. The DTCC has regulatory clearance and a defined rollout timeline for asset tokenization. Ripple holds operational access into DTCC clearing infrastructure via Ripple Prime. Institutional products distributing XRP are live in Japan. Government-backed real estate tokenization is expanding in Dubai. On-ledger lending capabilities are active through new protocol standards. These are not isolated headlines. They represent interconnected layers of infrastructure aligning simultaneously. The financial system is gradually moving toward programmable settlement, collateral mobility, and digital asset integration. Blockchain is becoming embedded beneath traditional markets rather than existing outside them. The critical question isn't whether tokenization is real. It's already underway. The decisive factor is which networks handle liquidity, custody, and settlement at institutional scale. Ripple's strategy has centered on securing access points within traditional finance, while building native blockchain functionality capable of supporting those flows. When the entity responsible for clearing trillions daily begins integrating tokenization, and Ripple holds structural access into that environment, the conversation shifts from speculation to infrastructure positioning. Over the coming months, additional clarity will likely emerge regarding how these systems interconnect in practice. For those tracking institutional blockchain adoption, the focus should remain on operational integration, regulatory alignment, and real product deployment, not price volatility alone. The architecture is being assembled, the plumbing is being upgraded, and once financial rails evolve, capital tends to follow the path of least friction. So how does Ripple intersect with DTCC operations in practical terms? Ripple acquired a prime brokerage firm known as Hidden Road and reintroduced it as Ripple Prime. Hidden Road already held membership within the DTCC's Fixed Income Clearing Corporation, specifically in the Government Securities Division. That membership provides direct access to the clearing system for U.S. Treasuries, one of the largest and most liquid markets globally. Ripple paid approximately $1.25 billion for that acquisition. That price tag signals strategic intent, not experimentation. Through Ripple Prime's membership, institutional clients can route Treasury and fixed income transactions directly into DTCC clearing channels. This is not an abstract association. It is an operational connection. When you combine DTCC's $11 trillion in daily settlement activity with Ripple's positioning inside that ecosystem, the potential becomes clear. Even a fractional shift of liquidity using XRP or rlUSD for settlement or bridging could represent significant transactional flow. Ripple hasn't merely partnered from the outside. It secured structural integration. And it didn't stop there. Over the past year, Ripple expanded aggressively through multiple acquisitions, covering treasury access, custody services, business-to-business payments, and stablecoin infrastructure. The result is a vertically integrated financial stack competing alongside traditional giants in institutional payment rails and asset servicing. This evolution reframes Ripple not as a speculative crypto firm, but as a financial infrastructure company using blockchain as its foundation. Meanwhile, tokenized real-world assets currently total roughly $25 billion, with U.S. Treasuries accounting for more than $10 billion of that segment. Projections estimate the total could approach $100 billion by year-end, a four-fold expansion in 12 months. Major institutions are building 24-hour on-chain trading systems with near-instant settlement. Global banks are issuing tokenized deposits in digital bonds. Money market products tied to blockchain rails are already live for institutional clients. The direction is consistent across the industry. Traditional assets moving onto programmable networks. The central question is no longer whether tokenization will occur. It's which infrastructure captures meaningful institutional scale. And Ripple has positioned itself squarely in that competitive field. There's also a protocol development many overlooked. A validator recently executed the first native loan directly on the XRP ledger using the XLS66 standard. In practical terms, that means assets can be locked, borrowed against, and governed automatically at the protocol level, without traditional intermediaries. Payments, decentralized exchange functionality, token issuance, And now, on-chain lending are converging into a comprehensive financial stack. Institutional entities are evaluating how these features could support treasury yield strategies and liquidity management. This isn't retail experimentation. It's strategic assessment for real operations. The XRP ledger is evolving into full-spectrum infrastructure rather than a simple transactional token network. And that leads directly into developments overseas.